watching the latest news from FinancialMirror.tv. U.S. Federal Reserve officials resumed a two-day meeting on Wednesday that is widely expected to end with at least a half a percentage point cut in interest rates. The decision by the Federal Open Market Committee, the policy-setting arm of the U.S. Central Bank, is expected later on Wednesday. The European Central Bank has pointed to the scope for lower borrowing cost now that inflation is receding, and the Bank of Japan is gearing up to cut rates at a meeting on Friday. Britain is forecast to follow by the end of next week to bolster economies facing recession, while Norway is said to be preparing for a half-point rate cut too, with the rush of rate cut news boosting European shares for the second day in a row. China also cut interest rates for the third time in 6 weeks to help the world's fourth largest economy ride out the reverberations of the global financial crisis. The People's Bank of China said the benchmark rate for one-year loans by commercial banks will fall by just over a quarter to 6.66%, while the rate on one-year certificates of deposit will drop to 3.60%. A senior chief economist with Citigroup in Hong Kong said growth is slowing down and policymakers want to take more action to contain the downside risks and to support sentiment in the market. The yen briefly dipped against the dollar after the cut, which will take effect on Thursday. Britain's blue chip shares soared more than 5% on Wednesday as investors were buoyed on the hope that the Fed rate cut would spur economic growth and quell fears of a global recession. The benchmark FTSE 100 index is still down more than 15% this month, on track for its biggest monthly fall since the crash of 1987. Oil and gas producers were the top gainers after crude oil climbed to $64 a barrel to end its three-day losing streak. Banks rallied on hopes that the Fed will cut rates to 1%. Standard Chartered, Lloyds, TSB, Royal Bank of Scotland, HBOS, HSBC, and Barclays soared between 4 and 20%. Mining stocks also tracked gains as metal prices rose. Shares in insurers leapt while retailers Marks Spencer and Next were higher. Shares in Volkswagen nearly halved on Wednesday after controlling shareholder Porsche took steps to ease the squeeze on the short sellers that more than quadrupled the stock in days. Porsche itself had prompted the meteoric rise in Volkswagen stock with its announcement on Sunday that it had effective control of just over 74% of Volkswagen, leaving less than 6% floating in the market. The stampede to cover open short positions after Sunday's announcement vaulted Volkswagen's market value to 278 billion euros and its shares to finish at a record 945 euros on Tuesday. Investors cried foul, and the German securities watchdog said it would take a closer look at Porsche's dealings for signs of insider trading and market manipulation. Analysts at Commerzbank estimated Porsche's strike price on its cash-settled hedges were around 100 euros per share, meaning Porsche could make 5.9 billion euros from selling 5% of its call options at a price of 500 euros. Only 24 hours after peaking as the world's biggest company by market value, VW stock fell on Wednesday as low as 491 euros as the market exhaled in relief that Porsche was releasing a part of its hedge and alleviating the worst of the squeeze. Sterling has managed a 38.2% retracement of its fall from 1.7510 to 1.5270, which came in at 1.6110 to the dollar. Analysts at BNP Paribas said the next key resistance comes in at 1.6390, which is a 50% correction, with some resistance seen at 1.6330. Now, at 1.6028, if the rate can get back above 1.6110, then this resistance area comes into play. Otherwise, risk is toward 1.5940 and on a break here at 1.5750. As markets digest a better-than-expected U.S. durable goods report for September, the dollar is beginning to show modest gains against the euro, though it remains weaker on the day. But the hard goods sector is not as healthy as August orders were revised to show a drop of 5.5% against the 4.8% drop first reported. And a key barometer of business equipment spending, orders for non-defense capital goods excluding aircraft, declined by 1.4% last month after decreasing 2.2% in August. The euro against the dollar is likely to trade in a neutral 1.2585 to 1.2840 band, according to BNP Paribas. A clear topside break would open risk towards 1.30, while a break below 1.2585 would open the downside towards the bearish breakpoint at 1.2445. The euro against the dollar was last at 1.2785. A $25.1 billion bailout of Hungary by the IMF and European Union settled nerves in the bloc's ex-communist countries on Wednesday, though the regional fallout of the financial crisis looked to have some way to run. The rescue deal, the biggest for an emerging market economy since the global crisis began, was the first for an EU member and dwarfed the $2 billion and $16.5 billion sums offered earlier to fellow strugglers Iceland and Ukraine. The full amount was twice what analysts said Hungary had needed and comes on top of a €5 billion facility agreed with the European Central Bank earlier this month. The agreement will force Hungary to make painful budget cuts that could worsen the already grim economic outlook of an impending recession, and analysts still wonder whether others in the region may yet need propping up. The massive rescue package for Hungary may also help the socialist minority government, but ordinary Hungarians are likely to suffer from painful spending cuts. Democratic presidential nominee Barack Obama launches an unprecedented television blitz on Wednesday to push his economic message on U.S. networks ranging from CBS and NBC to Comedy Central. Obama's television broadside may also force a 15-minute delay in the Fox network's broadcast of the fifth game of the World Series, the fiercely followed championship of Major League Baseball, coincidentally between the teams from Pennsylvania and Florida, both major battlegrounds in the November 4 election. Republican rival John McCain plans to appear on CNN's Larry King Live, hoping to woo viewers with his own vision of the country's future. The cost to the Obama campaign has been estimated at close to $1 million for each major network slot and reflects the huge cash advantage the Democratic candidate has over McCain. Obama, who has shattered all fundraising records, hauled in $150 million for his campaign in September alone. Unlike McCain, Obama chose not to accept public funding for his White House race, freeing him to raise millions privately. Thank you for watching FinancialMirror.tv.